Hello, everybody. Welcome back to another episode of the Loan Officer Wealth Podcast. So, we are here with Barry Rutten. And, Barry, thank you so much for being on the call.
I'm really glad to be here. I wish I had a cool T-shirt like you do. I don't have a cool guitarist T-shirt like that.
Well, it's cool until I was a dad, and now it's just lame.
Hard to be cool for your kids, right?
Yeah, that's right. Barry, it's so great to have you here. So, this is going to be a very interesting episode because Barry joins us from the financial services and wealth management world. So, our podcast here is mainly loan officers, and we're here helping them grow their businesses and doing more with less. And the name of the podcast is Loan Officer Wealth. And so, what we really do here is we provide the systems and processes in order for them to make more money. But I think today's conversation is going to be a lot more geared towards, well, A, how do you make more money with financial services professionals? But then also, what do you do with that money once you get it? And what are some of the strategies that you can talk to your clients about and talk to your wealth management team about in order for the client? So, I'm really excited for this, Barry. Thank you so much for being here.
Yeah, I'm looking forward to it. Let's jump in.
All right. So, first off, if you could just kind of give us a little bit of your background, how did you get into the financial planning world? How did you kind of come to be where you are today?
Well, I think a lot of people in my industry sort of fell into it, maybe accidentally, maybe as a second career. I was a little bit more intentional, but also accidental. I started out in law school. Like a lot of people, I didn't know what I wanted to do with my life or career. Everyone said I had a big mouth. I'll take that as good gift of gab. And so I did the whole LSATs and applied to law school and got accepted and arrived there not really knowing why I was there because it wasn't like, oh, I have a passion for the law and I really want to be here. And I'm watching all my fellow students just, study groups and briefing cases and really into it. And I unfortunately chose law school, University of San Diego in California. And I was like, oh, beach and sand and volleyball. And so I did not finish law school and broke my mother's heart,
Mm,
but went across the street to the undergraduate school and went down into the basement where they had all of the professional trade journals for every kind of profession and came across the Journal of Financial Planning, and it was a light bulb moment where I said, wow, that's kind of what I was thinking about law, in the sense of I like the idea of clients. I think the thing that was what is appealing to me, is helping people. But at the time in law school, law seemed so negative. You're taking criminal law and civil law, and it's all the bad people things, bad things that people do, and if I had known that there was entertainment law or sports law, I might have stuck it out, right? Because those guys are, I'd like a percentage of some of these baseball and football contracts or movie deals, right? So if they had a class on, other avenues in law school, I should have gone down that road. Um, so I because I was on a professional career track, I've always taken financial planning as a profession. I've gone through various roles where I was the primary financial planner or the leader of other financial planners or financial advisors. Um, but I really like the client contact. I like the more I get moved away from the direct client contact, the less happy I am. So I just like having that impact on people, and it's a very positive profession if it's done right. And I like the
yeah.
collaborative, cooperative nature of it. I just like the idea of clients and having an impact on really big life events. I'm way too squeamish to be a doctor. Like I can't even stand the sight of my own blood, let alone anybody else's. So in terms of helping people, I think it's kind of a close second to that kind of stuff.
That is fantastic. And so, in your the practice that you run now, what is your primary customer? Like, who is your perfect client?
Well, I'm really attracted to working with business owners for a couple of reasons. One, just their ability to make good strategic decisions. They wouldn't be in the positions they're in if they didn't have a certain mindset, that entrepreneurial mindset, that risk reward mentality. Although I don't think it's necessary to take a whole lot of risk. I think people maybe take too much risk sometimes. Um, but as I always say, business owners are people too. They have, like you said, they have families. And so it provides a diverse set of planning opportunities because there's always that interesting line and separation between the personal and the business, but also where they merge. So, for example, when I'm working with clients who are about to retire, about to sell their business, very complicated set of both planning issues and emotional issues with transition planning, succession planning, how the retirement and the estate planning and the income generation all work together and are integrated, working with the next generation, the successor generation. So, but at the same time, when it's not necessarily anything all that complicated, I just feel that there's so many opportunities for business owners to optimize the way they run their business so that if they were going to sell it or transition it, they get to do that for maximum value. So knowing what's going to happen out at the other end can guide me to providing business related advice that may even transcend what people traditionally consider financial planning. Because I'm working, actually, I have the certified financial planner designation, of course, but I'm working towards what's called a certified exit planning advisor,
Hmm.
and that actually has two parts. The I'm 62, I'm 65, I'm 67, I'm ready to hang up. How do I maximize that transaction? But also the value added process to their business at 32, 42, 52, knowing that at some point they may want to actually sell or transition that business. How do you run the business in an optimal way so that you get a maximum multiple for that business within any industry? And then within that range, how do you get at the top of the range versus the low end of the range? So that's all very interesting stuff to me.
That it most definitely is. So I think that there's not nearly enough conversation and not nearly enough weight given in the mortgage industry to the fact that we are building an asset, that we are building a business that could potentially be sellable. Now, an individual loan officer working, I know, in a team structure doesn't have that, but somebody who's actually starting a business within the mortgage world and potentially in a brokering capacity or something else, what are the things that you think people in the mortgage industry should be looking at in order to build that maximum value, in order to look at it not just as like, okay, I'm going to do this for 20 years and it's going to create a great lifestyle and a great income for me and my family, but I'm just going to like close the doors and walk away from my book of business in 20 years. What does somebody need to be thinking about now in order to really put that exit pathway in place in a business?
Yeah, great question. I think the challenge in specifically in the mortgage industry, or in frankly any commission based, transactional based business, is to transcend the cycles. Uh,
Hmm.
I'm old enough that I've been through several interest rate cycles, boom and bust cycles, market crashes, interest rates up, interest rates down. And, as your audience knows better than I, as interest rates have risen, all of a sudden, people are just going out of business. It was real feast for a while, or a long while, really. Now, certain people who maybe didn't have a real business, uh, there could be a period of famine. I think for the true business owner, I think you have to think about those cycles, and I think you have to figure out, how am I providing value that causes people to choose me, continue to choose me for their financing needs, and are there other financing needs that are necessary that transcend the primary mortgage loan, the personal residence, business lending, if they're doing that, commercial lending, if they're doing that. One of the things, just as a simple example, is as a financial planner, one of my sort of foundational issues for both individuals and businesses is you should have an emergency fund
Hmm.
commensurate with your spending burn. How much do you spend per month and how many months? And it used to be, 6 months. I think we've seen with things like the pandemic that may still not be enough.
Yeah.
A year I would not consider excessive of having your monthly required living expenses or monthly required business expenses. Um, and so, for example, with a family, I might say, what part of your practice is tied into home equity lines of credit,
Yep.
where a person could tap that line if they were to lose their job, let's say, and they need to borrow, 9 or 10 grand. And then the fact that a HELOC has pretty favorable repayment terms, it could be interest only, and then pay principal when you get back on your feet. Now you have a role in that family's life that transcends the one-time transaction, the home purchase. It's also probably a highly referable activity. And as a financial planner, I'm always looking for uh, mortgage lenders who kind of understand that idea that part of their role is not just to get the person in the house, it's to get them to stay in the house,
Yep.
right? So there's a kind of a 1-2 punch where two loans could either be made when they issue the loan or after. I'm not trying to get into their business, but I think that's the kind of thing that. And the other thing is, do you have systems and processes that make the business transferable to another entity? If it's just you, if I don't have the Chris Johnstone personality, if it's the cult of Chris, that's great for Chris while he's in business, but I can't probably sell that. I may not be as dynamic and interesting and good looking as Chris, so I can't necessarily buy that part of the business. I can only buy what would create repetitive income. So I think you got to think about what creates repeat income, repeat business. What are you doing to nurture and cultivate? I've done obviously several personal mortgage transactions in my life, no follow up, none. Like the
Yeah.
deal's
Mhm.
done and they're gone out of my life. And I did the largest transaction that I've done in most things. And that person is not communicating with me. Actually, there's a person I get mail from who was simply a loan officer prospect of mine, meaning he was one of the people I was considering. He's done a better job of following up on a regular basis and providing value than the people I actually gave the business to.
Yeah.
Which is stunning to me because we all in our kinds of industries are we would love to have the introductions and the referrals, but are you introduction worthy?
That's
What are
right.
you doing post sale? I know this is a very long answer, so I'll stop. But
No, no, no. It's good.
those are some thoughts that come to mind.
Yeah, and in the mortgage business, we see that all the time. Just it's transaction based, and has been. The last 2 years, the refinance boom was epic,
Mhm.
and the largest problem that we had in the mortgage industry was processing all of the deals. And now the cracks are starting to show. And I think every loan officer and every business owner needs to look at their business from an aspect of what what's going to happen when the dancing bear stops. Like if you don't show up and dance every day, is the business still sustainable? If could you go away for 30 days, come back and still have a business?
Right.
And I think systems to network with your database, get repeat business, referrals, 5-star reviews on your Google profile, a business, not, how do I put it? A relationship based person within the organization who's a business development representative who's responsible for building and maintaining referral relationships. So that's realtors, financial planners, investment advisors. Like having that layer of you not being the person in charge of those relationships
Mhm.
totally frees you from the business. And then when a new lead comes in, having a concierge that takes that lead, qualifies the lead, books that into somebody's calendar that can actually do the initial application discussion. Like where a lot of loan officers hold the most amount of value is not getting the lead, not getting the referral partner, even though those are the two most profitable activities they can do. But it's when you get the lead, how to structure the loan and how to actually structure that. And that's a transferable asset. A loan officer A and loan officer B can both be just as good at structuring that loan. That's something, if you've got all the other systems in place, all of a sudden you've got a saleable asset. But so many people never take the time to put the proper database marketing system in place, put the referral partner marketing in place, put the lead generation capture in place. And those are the three most important things in
And if I
order to
can
have.
just kind of come at it from the I don't disagree with anything you're saying, but I think
Mm,
I think there's a missing piece to that.
yeah.
And that is the transaction a one and done, and is the follow-up solely for the benefit of the loan officer, which is kind of what you're describing. And it's very important because we all need to make new money, right?
Yep.
But is the follow-up, to put a word to it, selfless? And is
Yeah.
the follow-up beneficial to the client independent of a transaction or a referral to the loan officer? So I'll be self-serving here for a second. So if the loan officer introduces somebody like me to the client, and because of the nature of financial planning, retirement planning, tax planning, income planning, estate planning, retirement planning, that whole thing, college planning, risk management, the whole spectrum of financial planning, I'm going to maintain a relationship with that client. I'm
Yep.
going to be inputting all their financial information into my super fancy financial planning software. It's going to get automatic data feeds pulled from bank accounts, credit cards, investment statements, etc. We're going to meet periodically, probably quarterly. Well, at some point, that person's going to want to buy another house or need to refinance the existing house or need that HELOC. So I'm going to be maintaining a relationship with that person on way more touch points than the loan officer. But if I know, you don't forget where your bread is buttered. If I know who made that introduction, and that's going to be in my CRM, right? That's going to be in my database. Then when it comes time to maybe they want to access their equity to do another, start a business, let's say. I'm going to say, hey, let's get together with Chris and see what the lending options look like, right? So I'm a conduit to come to bring that transaction back to that. But the other thing is that are you adding value to the client's life in other ways that have nothing to do with your own time or resources? Are you offering them your curated, vetted list of suppliers and vendors? Whether it's the folks. I see this all the time in all these neighborhood Facebook groups. Who has a good orthodontist? Who has a good guy who paints houses? So a loan officer should be at the nexus of a lot of that kind of stuff. And then it doesn't have to be you, but it could be somebody else managing that list of vendors and recommendations. And again, what are you to that client? Somebody who just did a transaction for them and did some paperwork and made it go smooth, or somebody who's actually part of their team
Yep.
for the client? And some of those. So, for example, if I can recommend a really good painter who's not going to ruin my house and do a really good job, when the client who gets the house painted bumps into somebody who needs a loan, see how that loop closes because of painting, right? Which has nothing to do with lending. And the other thing is the keeping the client financially solvent, right? Because I'm going to
Yep.
make sure they have a good risk management program. Keeping the client in the house, paying the mortgage, maintaining their credit, enhancing their credit, might put them in a position to transcend just the one transaction for their personal residence, and all of a sudden they start becoming a real estate investor.
Yep.
They start needing to acquire other loans of other types, whether it's bridge loans, construction loans, things like that. And depending on the mortgage officer, maybe something more, I want to say hard money, but maybe something hard money related, depending on what they're doing. Is it fix and flip and such? Um, so again, are you part of a strategic team with that client, or were you just one of many people who could have done the same transaction?
Yep. Oh, 100%. And that referral network and the broader it can be, absolutely far more valuable. So Barry, let's switch gears a little bit and talk about the actual financial planning aspect for loan officers themselves. So mortgage industry is a phenomenal industry where we can make a significant impact in people's lives and get paid, accordingly and well in order to do that. So I know we've got a lot of listeners that, the podcast is Loan Officer Wealth. So we're making this great income. What are your recommendations as a financial planner for how a loan officer should be looking at that income? How should they be saving? How can they really take income and turn it into wealth?
Yeah, it's interesting. As you were forming the question, I was kind of putting the word income and the word wealth on either side of the teeter totter, right? Because
Hmm.
you didn't name the podcast Loan Officer Income. You named it,
Yeah.
you named it Loan Officer Wealth, right? So the goal, as I think most of your listeners realize, is to not just make transactions to generate commissions to pay the bills, but to essentially turn that income into wealth. And if you're in the lending industry, I think you're obviously very real estate, for example, sensitive. But there's other things that you can put your money into, beyond real estate that also generate, very attractive returns. But the idea is that you know having a wealth mindset, right? um, and having a financial independence mindset. And there's especially for some of your younger listeners, they're probably more aware of the FIRE, FIRE movement, financial independence, retire early, which I think is great. And it's the idea of not living above your means. It's not necessarily being in the most expensive house in the neighborhood. It's not being what I call one of the Rolodex bros, like, look, I've got 6 watches that each cost $30,000. And I'm like, are you kidding me? You have 2 wrists. Um, you know, are you leasing a $900 a month car? And you can say, well, it's deductible. I'm like, well, not spending $900 is better than not, getting a 30% deduction, right? So are you making good money moves? So first of all, do you have a good defensive position? Wherever you are financially right now, what is your ability to withstand and recover from economic hardship, uh,
Hmm.
change in the market like we're experiencing now? um, Something that would happen calamitous in your own family. Let's say you're a two-income household and something happens to the spouse. Something happens with your children, God forbid. Um, so, do you have a good defensive position? Do you have a good risk management program? Do you have good cash reserves? Are you essentially addressing the idea that you can prevent the preventable? Everything bad that's going to happen, we can foresee, we can plan for, address, put resources in place. Okay, now we can't go backwards. We got a financial brick wall behind our present financial position. Now, if we let's just say, for those of you who are listening, I'm trying to drawing a vertical line in the air here. If in 2023, because we're doing this at the end of November, so I'll advance datas to 2023. If we've got a good defensive position, then we can't go back to where we were in like 2013 or God forbid 2003, right? But we're going to go forward to 2000 and whatever, what's 10, 2033, right? We need to move that brick wall simultaneously behind that new position, because if we leave the defensive position where it is here, we've now created this 10-year gap that I can fall back to again.
Right.
So you always want to be moving your defensive position forward to match where you are financially. Once you've done that, now the question is, if I've avoided financial loss, how can I achieve financial success? For most people, no matter how much we love our professions, no matter how much we love our clients and customers, if I said, whatever you're making now, I'm going to deposit into your bank account every month and you don't have to do anything, you'd stop working, right?
Yep.
That's financial independence. So the question is, how do we turn the labor of today into the financial independence of tomorrow? And that's simply income capture and conversion, right? So spending less than you make or making extra beyond your needs. You can look at that one of two ways. One's maybe a little more hustle, because you can only live below your means so much, and then it becomes no fun, right? So the
Right.
question is, how
Yep.
do you limit, reasonable expenses and then add revenue on top of that beyond what you need, and capture and hold on to that and not fall into the common financial traps that a lot of people make. I'm kind of well known for my sort of contrarian ways, and I really want to get out there and start, on Facebook or something, saying, where are the crypto bros now?
Yeah.
Where are those guys? All of a sudden, they're all quiet. They're not
Yep.
posting their accounts, right? Where are the Robinhood guys posting their accounts? Where are the meme stock guys posting their? So I think the idea is, how do you capture and hold on to and maintain and grow and compound that income, and then turn that into an income stream? And that doesn't have to be retirement based. It could be a hybrid lifestyle, right? At what point do you have enough assets and wealth that replaces your wage income? It doesn't mean you have to stop working. It
Yep.
means you can stop sweating it.
Right.
You can stop worrying if you're going to close that transaction or not, because all your expenses are covered.
Yep.
So maybe you just have a less stressful life, which is a fantastic milestone.
Hmm.
And I call that hybrid retirement. Retirement is an old-fashioned term in my mind, and if you may, I want to expand on that.
Yeah.
It used to be that, first of all, the idea of retirement is relatively new, right? If you go back into our country's history, you worked on the farm or in the factory until you were dead. There was no like stopped working, right? And the other thing is, even in the 30s, when they established Social Security, they picked 65. Well, life expectancy was probably 67.
Right.
They never expected people to have 30 years of Social Security, right? It's just that medical advances and everybody's eating kale, people are living longer. Retirement as a construct of sit around and do nothing, I think has become a kind of an old-fashioned idea, and I think they've also discovered that it's very unhealthy. right?
Hmm.
People just doing nothing. It's just not good for the body. It's not good for the brain. So if we can call it a hybrid retirement or hybrid work and say, I've got income generating assets that are independent of my labor that produce cash flow. And if I don't put the income producing assets at risk, because I don't think you should be drawing from what we'll call variable return assets. So I think the idea of, say, drawing from a stock portfolio is a flawed idea. When I set up retirement income distribution strategies for my clients, the money comes from essentially riskless assets, cash, short term things. And then if the money's kind of coming out the bottom of the tank, we're using other tools that are very reliable to replenish the top of the tank. And then we're using other assets to replace those assets. So we're never like, oh my God, something bad happened on Thursday. I can't pay the fuel bill, right?
Right.
I can't buy the groceries. That's crazy to put yourself in that position. And yet I see that all the time. Oh, our retirement was great, but now the market went down and we're spending our principal. And every time we spend principal, it's irreplaceable. And so now I kind of on this death spiral
Yep.
where it keeps going down and down and down. So we want to keep people out of that. But if we can have income generation plans that pay all the expenses, now the labor, right, the new sale, the new commission can go into the wealth building plan, not the pay the home mortgage, not pay the electric bill, not pay the food bill. So meaning that financial independence gets better and better and better, and the necessity of work goes down. And then you can say, you know what? Maybe I don't want to be in the transaction business anymore. Maybe I want to be, more of a lender myself. I have enough assets where maybe I'm lending money to other people on my, attractive terms.
Yep.
Maybe I'm investing in, multifamily properties or commercial real estate. And, you make this transition from being a transaction-based person to a strategic person, I guess I would say. And
Yep.
so I think there's that, where are you in your career? And I think you want to operate as if you are already in the position I described, because I think that's appealing to people. And then how do we back into that? And that's a big conversation I like to have with any of my business owner clients, regardless of what business they're in. Because if I said, hey, I'm your new Uncle Barry, your benefactor, and I'm going to write a check and deposit into your checkbook every month for whatever your expenses are now, would you work? Eh, probably not, unless you're a pro surfer and really loved it.
Yeah. Yeah, absolutely. So we've got so I had a really good mentor of mine one time tell me, Chris, if you just want to get by in retirement, save 10%. If you want to be middle class in retirement, save 20%. And if you want to be wealthy in retirement, save 30%. And then I had another mentor come to me, a good dear friend of mine, and he said, Chris, don't save 30, save 50. Because you just live on the 50% and take the other 50% and bank it. And that was a big moment for me. And that was really, really good advice that I got very, very early on in my career. And my wife and I have continued that. And then we discovered that there's a point that you get to in your income where the amount of additional income, the amount of additional sales or commissions that you make, they really don't have any they don't have the effect on your life. Like when you go from 50 to 100 grand,
Mhm.
there's a difference in the quality of your lifestyle as a result of
There's a
that.
jump there for sure. Yeah.
There's a jump there for sure. But if you go from 200,000 to 400,000, your life doesn't, unless you're going to go out and blow it on a Bentley and the four
Well, and
Rolexes or
that's the
whatever. Not
interesting
that there's
point,
anything wrong with that.
right? It's the what do you do when the income rises? What action do you take? So what I found, and I actually didn't come up with this, other people have studied this, is that people at lower income levels tend to buy stuff, small stuff like iPhones and things,
Yep.
because there's this momentary rush of, "Ooh, I got this cool new shiny thing," and it lasts for about 20 minutes because everybody else has one and nobody's really impressed. But there's this like momentary, it kind of makes you feel good that I bought this new. It's what I call the consumer electronics industry sucks up a lot of people's money.
Oh, absolutely.
The new TV, I once was on a sort of a discussion board. I was looking at getting a sound bar for the TV and I was like researching. And a person asked a question and the other person responded, well, the blah 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 soundbar has these sound specs, megahertz or whatever hertz or whatever it's measured in. And this other bar has this. And bar A is better than bar B because it has more of this. And somebody else wrote back and said, well, that's great, but the numbers you're referring to would only apply to a German Shepherd because that's outside the range of human hearing. Meaning that the businesses can build these things, but my ability to tell you if there's 80 billion or 50 billion pixels on my TV is pretty limited. And I know there's experts in audiophiles and everything, but the point I think you're trying to make is that there's an incrementalism with diminished returns.
Yep.
And it's what I was talking about before. One really, really nice watch, if you love it, do it. But two or three or four or five or six, and are they investments? I don't know. Are people going to really buy your watches down the road? I don't know. Maybe. But the point is, the people at the low end tend to buy stuff. Here's the problem. The people who start to get some money, the middle end, you know what they have? Liability creep.
Yep.
They increase the house when does it really appreciably improve their life? Now, if you're in a bad school district, move. I get it. If Get into a better school district, get into a safer neighborhood, buy a view, nice neighborhood near where you love to be. I get it. But to just keep adding and adding to the liability side, where you owe more and more and more money and have to work more and more and more to pay a mortgage. And I know I'm talking to loan officers here, but I'm just saying the more you obligate yourself with liabilities for cars and houses and everything else and credit cards, the wealthiest people you see buy assets,
That's
right?
right.
They turn their income into assets and income generating assets. And I know there's shades of gray here, but it's a philosophy. So to your point, I agree with you. I actually did not grow up in a money household. I did not get the 50% of your income advice. And early on, it is really hard. Maybe you can only do 20%. But if your goal is, hey, every time I make more money, the thing I started to do when I made more money was just save more, just save, save, save.
That's right.
So every time I made more money, I just simply increased my automatic contributions. And if there's actually a book called The Automatic Millionaire.
Yep.
And if I can give one piece of generic advice, that is establish those emergency funds, establish those investment accounts, and keep increasing your percentage contributions to them, whether those are 401ks, whether those are, outside investments, whether those are savings, so that don't just grow into your increased income. So a simple formula could be save a third, spend a third, invest a third, right?
Yep.
So some stuff to savings, some stuff to investments, some stuff to increase spending. Just don't absorb all of it into the spending habit, because that's really how our society is built, is to get people to just simply spend more. Two-thirds of the economy is consumer spending,
Yep.
and you have to resist it. It's really, really insidious. I know that I was, it's Thanksgiving or just post Thanksgiving, and I know I was a victim of the Black Friday, Cyber Monday stuff to some degree. I really wanted a smoker. I finally pulled the trigger because they had a really, really good deal on a smoker, and I've just been looking at recipes for meat and stuff until my smoker arrives. And a couple other little doohickeys and doodads and such. But um, you know, I think that if you have a wealth mindset, then you have to have an asset based mindset, not an income and spend based mindset.
Yep, 100%. And so when it comes to asset allocation or asset acquisition, and again, Barry, I'll be respectful of your time here, but it's when you see somebody starting to walk down that road of acquiring assets, do you have a framework to go after as far as like this much in stocks and bonds, this much in income producing real estate, this much in second mortgages? Like, what does that look like because we have a lot of people in this group that are walking down that path. They're allocating capital, they're acquiring assets, they want that cash flow. So what's your advice to people that are in that?
I'm going to give you one weird answer and then a really, really tangible answer.
All right.
There's a common advice of which is don't go shopping at the grocery store when you're hungry without a shopping list.
Yeah.
I think what's dangerous is to just go out there and say what's good.
Yep.
What's good to invest in? I've had that question like my entire career for 35 plus years. What's good? What's good? What's good? Well, of course, it depends. Professional investors, when I say professional investors, I mean the managers of multi-billion dollar college and university endowments, pension plans for public employees, corporate retirement plans, et cetera, all operate off of very specific investment policy statements. So one of the first things I establish with my clients is an investment policy statement. What are we trying to accomplish? And what are the rules that we're going to establish for ourselves in selecting investments and in designing the asset allocation? And when will we change it? When will we not change it? Because predominantly people tend to jump around, too much, and they make emotional decisions and they chase the hot thing, and they tend to not actually get the return of that asset class because they're usually not in the asset class. The other thing that we've seen is that in 2008, 2009, when you had the first, kind of mortgage meltdown, and now you have the recession we're probably in or going to be in, the the challenge is that we have such an interconnected world now that the typical, I have so much in stock, so much in bonds, so much in real estate, like everything went down this year. Everything.
Yep.
There was literally very, very few places to hide. Then there were a couple that were more what I would call strategy based, meaning there are tools that we have at our disposal now that have only been around for, well, some of them have been around for a while. People are just not aware of them, where you can capture a lot of market upside, but not necessarily experience the downside. They have come in a bunch of different flavors. So that's the first thing. The
What
second
are
thing,
those?
pardon me?
I said, what are those?
Oh,
Is that
well, I make it a
insurance?
I make it a practice not to do specific recommendations because it flies in the face of my
Smart.
philosophy. But there are insurance-based and annuity-based ideas where they use indexing strategies to capture the market's performance, but are designed to not. It's like a roller coaster, right? Up, down, up, down. They tend to go more like a staircase up when things go up, but maybe not all of the up. And then when things go down, instead of riding it down, you just kind of stay flat to live another day, and then you go from that high point to the next high point, flat when the things go down into the next. So they have those in insurance, they have those in annuities, and they actually have those in what we call direct equity based items, where you can actually a lot of the big banks have put together things where you can participate in the indexes and have some protection. But all these things have to come with disclosure and research, and but the marketplace responds to the demographics. The
Yeah.
demographics of an aging society have said, we can't take the roller coaster anymore. Give us some way to mitigate the risks. And there are probably three or four big categories of doing that that are very client specific based on what else is going on in their life, else is going on in their finances. So I would just say the tools exist, but don't just start randomly shopping them, because I get lists of these things um, that even for me, it's just sometimes hard to say, okay, here's 30 different ways to do this. They all have like little different tweaky angles to them. Which is the best, one for me? I do like to get paid. I think that's one of the best things I can give as far as generic advice. If you're in stocks or in real estate, those are equity based.
Yep.
If you're just waiting around for appreciation, that's a slow boat.
Yep.
I want to get paid. I want to get paid maybe in the form of rents
Yep.
in my real estate. I want to get paid in the form of dividends in my stocks. So let's say you're in stocks and you want to earn 7%. Well, if it pays a 3% dividend, right? That's the return of the part of the profits from the company. Then I only have to earn 4% in terms of growth to hit my 7% target.
Right.
If I'm in real estate and I want to make a certain return, there's the rent return, then there's the appreciation return, and the deduction values. When it comes to bonds, who am I lending to? Under what scenarios, right? Bond lending can be more complicated than stock investing. There are things that sort of look like stocks, but kind of perform more like bonds. Like there's things like uh, what do they call midstream energy? So we all have heard a lot of noise about pipelines for several years because there's been a lot of pipeline controversy. Well, what a lot of people don't realize is somebody owns the pipelines that exist now. Somebody owns those storage tanks. And the oil and gas companies pay fees on long-term contracts to have access to those pipelines to move the products from the ships and the shore into your gas pump and gas tank and oil tank, and very lucrative businesses. Very nice returns, very stable, boring, right?
Yep.
But boring is good, right?
Yes, that's right.
It, you know, the whole Warren Buffett idea of own stuff you understand. I understand I've got a ship full of oil from wherever they produced it, lands in Alabama. It needs to be, well, probably maybe Galveston, Texas. We'll use that. It's got to go into a storage tank, and then it's got to be pumped to somewhere, say, in the middle of the country where they don't have a port where a ship can land. Let's say Kansas. Somebody owns that pipeline. Somebody's paying an access fee. I want to own the businesses that own those pipelines to be able to be paid those fees. It's a good example of it. Again, this is not investment advice. This is just kind of talking about things generically, but it's a good idea to understand that there's things out there in the world that you may not know exist.
That's right.
Part of the job of a good advisor is to know they exist and know if they apply to you and they fit your situation and make them part of an overall plan or strategy. But I would say that I like to get paid. I like my clients to get paid for the deployment of their capital. There's a thing called the greater fool theory. And I don't know if anybody knows the history of like the Dutch tulip bulb,
Yes.
um, where people just started buying tulip bulbs because somehow people believed tulip bulbs were going to become more valuable, and everybody lost a lot of money. It's kind of some of the same stuff I see going on today. The greater fool is, I'm going to buy something for X, and some greater fool is going to buy it for Y in the future.
Yep.
That's speculation. That's gambling. That's not prudent investing. It's not prudent planning. I don't think we're all attracted to the Powerball. We're all attracted to get rich quick.
Yep.
That's usually a recipe for disaster. You want to blow $10 on Powerball? Be my guest. I did too. But it's not a strategy. And owning things that you understand. Warren Buffett owns a lot of really boring things, but you know what? Owning Coca-Cola that makes sugar syrup, sugar
Yep.
water, right? But we put it in a can, we put it in a bottle, we put it at the vending machine, we put it into the movies theater, and it just makes money. It's really boring, but it just makes money. So I think really we can become very familiar with something. So if we're in the real estate business, we're really familiar with that. You can become undiversified, right?
Yep.
Either by asset class, I own a bunch of rentals or a bunch of single family homes, or I'm really concentrated in one state that has a natural disaster that wipes out my whole portfolio. So I think diversification across asset classes, across regions, across businesses, investment types, it's all really, really, really good, but it should come as part of a plan and a strategy. And we have a lot of statistical data that help us sort of manage and massage and allocate that. Here's the other problem. People tend to not reallocate.
Hmm.
So if I have 25% in something and
Yep.
it does really, really, really well, human nature is like, I'm not going to sell this. This thing is up.
Right. Yep.
But if you stay true to the allocation, you need, and now the thing's worth 32% of the pie slice. The discipline is to sell off that excess and
Yep.
invest it in the things that didn't do so well, because those are probably poised to do well uh, next time around.
Yep.
And so I think for anybody listening, if you're working really hard, which I know all your listeners are, capture as much of it as possible and don't give it away in the form of things that have short-term, value, but not long-term benefit.
Yep.
And, buy all the fun stuff you want. I'm not draconian. I bought. Look, I'll be honest. This is full transparency. I own 2 boats. Okay,
Ah, that's
so
awesome.
I'm being really transparent. So I've one larger boat that's capable of doing like overnight stuff, and I have one day boat that's really kind of fun. They're ridiculously stupid, right? They cost money to buy. They have to be insured. They have to be maintained. You have to put fuel into them. They're very fuel inefficient. They break. It's dumb, but it's fun, and I enjoy it, and I love it. But they're all paid for. You know
Right.
what I mean? And and I maintain them so they don't break in a big way. They break in hopefully little ways. So I don't want to think like I'm some saint, right? I still live and enjoy my life, but at the same time, I'm very cognizant of the fact that the world changes, people change, circumstances change, situations change. We want to have a good defensive plan. We want to have a good offensive plan. And I love that it's loan officer wealth, not loan officer income, because we're all pretty good at making an income.
Yep.
Not all of us are good at turning that into long term, especially intergenerational wealth, not just for
Yeah.
you, but for your kids and your grandkids and things like that.
Absolutely. Well, Barry, I think that that's a fantastic stopping point there. For our listeners, if they're interested in a deeper conversation with you or to learn more about what it is that you do, where do people go? Where can people get more information about you?
Sure. Go to wealthdefensegroup.com, real simple website, wealthdefensegroup.com. And I would just simply say there's a contact form on there with a bunch of different categories of things we can talk about. Just schedule, just go on there, tell me you want to talk. I like to have a conversation. I'm not a fit for everybody, but we won't know that until we have a conversation. If you're intrigued by anything that I've talked about here, reach out, fill out the form. We'll get in touch. You can tell me if you want to talk by email or phone or God forbid text. I have a thumbs limit. Um, and then we can have a conversation. If I'm your cup of tea, great. And if I'm not, great. And if I'm a fit for any of your clients where I can be of service to your clients as loan officers, I'm happy to do that. I try to give people a feel for how I work and my philosophy. And I've been doing this for a long enough time where I don't feel like I am a victim of the fad of the moment. I think there's
Right.
some things that have just proven to be consistently, reliably true, and I try to stick to that world.
That's awesome. Well, again, Barry, thank you for being so generous with your time and for being on the show for all of our listeners. Don't forget, head on over to iTunes, leave us a 5-star review. That certainly helps us get more great guests like Barry and helps us with the algorithm. And if you're watching this on social media, make sure you hit us with a like and post a comment below on anything that you took away from the episode. Any aha moments out there, we would certainly appreciate that. And again, Barry, thank you so much for being here today.
Thank you, Chris. I really, really enjoyed it. Thanks so much.